Hello, and welcome back to Nonprofit Auditor Points. I'm Irina Ryshkova, your nonprofit auditor. And we continue our series about the fixed assets, accounting, depreciation, policy and procedures, and all other related issues to fixed assets. In our last episode, we discussed construction in progress and placed in service concept. We talked about when depreciation begins and how organization accounts for projects that's still under construction or development. Today, we're going to focus on another important area of the fixed assets accounting that creates a lot of amount of confusion in real life. And we're going to talk about land and building allocation. It happens very often. This topic matters because it's not only real estate treated the same way under GAAP. Buildings are generally depreciated. Many land improvements are depreciated as well. However, land itself, generally, it's not depreciated under general accepted accounting principle. So when the nonprofit purchases a property that includes land, building, parking lot, fencing, landscaping, and other improvements, the organization often need to allocate the purchase price between different type of fixed assets because they have a different accounting rules under GAAP. So from the audit perspective, this is another area where we find a lot of mistakes, confusion, and various errors. Sometimes organizations record entire purchase as a land and record no depreciation at all. Other times, organizations allocate unrealistically small amounts to land and don't depreciate, but depreciate a lot to the building. And occasionally, organizations simply skip everything combined, everything in a large account that's called real property. So today we're going to discuss why land should be treated differently from the building. The difference between land improvement and building, and how methodology-wise the organization should allocate purchase price between land and building and other assets. Let's start with the most basic question. Is land considered fixed assets? Yes, so land is recorded as a fixed asset. Land is long-term asset used in organization operations, is generally reported within property and equipment on the financial statement. Why, unlike most other fixed assets, land is not depreciated? And the answer is because based on accounting treatment, depreciation is a methodology that we use to allocate the cost of the asset over the useful life of the asset. And buildings wear out over time, vehicles also become obsolete over time, equipment become obsolete. However, land is generally considered to have indefinite useful life. So in accounting terms, it's planning to live forever. So there is nothing to allocate. So once the land was purchased, it gets recorded as a land on fixed assets and it does not get depreciated or appreciated. So we do not record gain or loss on land. It's recorded cost and stays in cost until the asset is disposed. So therefore, under general accepted accounting principle, a land is non-depreciable fixed asset. Now, we don't want to go too deeply into unusual exceptions because this video is supposed to be practical overview, but there are rare situations involving things like extractions activity or environmental issues where different accounting consideration may arise for the land, but we're not going to talk about it today because it's not applicable for most small nonprofit organizations. So we're going to stick just to land that typically acquired as a part of the building purchase as well. So for most nonprofit organizations, general rule is straightforward. Land itself, it's not depreciated. So let's move to another important practical discussion of this area and its difference between land improvement, and building. Because organizations sometimes incorrectly combine all of them in one asset, that's not the proper treatment. Land refers to the site itself, and certain permanent improvements are considered to have indefinite lives. Building is a structure that attached to land, and buildings do have a definite life, and they have to be depreciated. Land improvements are improvements made on land, and they also have a limited useful life, and they deteriorate over time, so we do need to depreciate them, land improvement as well. So this is important difference between different type of assets. So let's look at examples. Parking lots are usually considered land improvements. So fencing, sidewalks, driveway, exterior lighting systems, irrigation system, certain landscaping improvements are commonly treated as a land improvement, and because they wear out over time and eventually require replacement. So even though these improvements are physically attached to land, they usually depreciate it separately. Now let's compare to the land itself. The site, grading work, certain permanent changes to the land, portion of landscaping considered permanent in nature and maybe part of the land account and therefore generally not depreciated. So typically we see the purchase of the land itself without any improvements, that part is not depreciated. In practice, decided exactly which costs belonging to depreciable part, like a land improvement or land itself, could be point of judgment. But I would say that the things that typically would live forever and do not require replacement will be part of the land. Let's move into another major issue, purchasing of property that includes both land and building. This happens very frequently in nonprofit organizations. So for example, suppose the nonprofit purchases an office building, such as church property or school facility or community center, and typically involved land, building, and sometimes additional site improvements. And all of these assets needs to be accounted differently. Why? Because the building is depreciated over future years and land will not be depreciated. So organization needs a reasonable allocation method to allocate between depreciable asset and non-depreciable components. Under general accepted accounting principle that allocation should be generally be based on a relative fair value at the day of acquisition. Now let's talk which methods we can use to do such allocation. The strongest and most supportive methods, it's actually professional appraisal. Typically, when the fixed assets building is purchased, there is appraisal. And appraisal may separately list value of the land, building, and sometimes significant sites improvements. So these appraisal can be used to allocate the cost in accounting records. This is the most defensible approach because it's done by a professional appraiser, specifically for large transactions. However, smaller nonprofit organizations do not always obtain detailed appraisals specifically for accounting allocation purposes. So what do we do then? Another common approach is using county property tax assessment information. Many counties separately list land value and improvement value. So organizations sometimes use these percentages as a reasonable basis to allocate purchase price between land and building components. Now, property tax assessment is not perfect, but nonprofits needs to have some basis for allocation, and basis needs to be reasonable. Assessment value may lag market conditions and may not design specifically for GAAP reporting purposes. But in many practical nonprofit situations, they may still provide a reasonable and supportable allocation method. Other approaches may also be used. For example, contractor estimates, engineering studies, sellers breakdowns, replacement cost analysis, or construction plan may help organization estimate reasonable value for different property components. So as long as some reasonable allocation is done and properly documented, it can be applied. Auditors generally become uncomfortable when organizations use completely arbitrary allocation without any documentation support or methodology. So, however, if methodology is thought through, documented, and supported, auditors typically will take it and use it. Let's talk about why auditors focus on this area. One reason is depreciation. If it's too much cost allocated to land, meaning too little cost allocated to building, depreciation expense may be understated. If it's too little cost allocated to land, then too much depreciation will be recorded and expenses will be overstated. And typically, cost of the land and the building are quite material, substantial numbers. So that overstatement or understatement would be very material distortion of the financial statements. And because depreciation affects expenses, net assets, overall financial statement presentation, incorrect allocation can have material effect on financial statement presentation. So if the allocation is not done properly, financial statements can be materially misstated. And that's the whole purpose of the auditors, to provide an opinion, which is that financial statements not materially misstated. Therefore, it becomes a very important area for the auditors to concentrate on, because it's a material issue which can cause financial statements to be materially misstated. Auditors may also heavily concentrate on the following: are parking lots properly classified as depreciable land improvements? Are buildings separated correctly from land? Are the organization depreciating assets that should have been depreciated, or failing to depreciate the assets that should be depreciated? And another common mistakes in areas that auditors concentrate is maintaining incomplete or overly simplified fixed assets records. Sometimes organizations maintain only one combined land and building account with a little support for how balances were originally allocated, because the amounts are carried over from one year to another, their balance sheet accounts, and the building may have been purchased 20 years ago, but they're still in the books as of now, and the auditors need to understand where the amounts came from, how they were allocated, what methodology was used 20 years ago. And if years later no one remembers how the allocation was determined, whether the land improvement was separated, or if depreciation expense was properly calculated and reasonable, the auditors have a hard time obtaining reasonable assurance that these amounts are not misstated. So from the practical perspective, Organizations benefit greatly from establishing clear documentations at the time when the property is acquired, because these records can be audited for maybe for 30, 40 years, as long as the organization still has a building, and sometimes useful life of the property of the building is 40 years. Therefore, proper, good, robust documentation of allocation, analysis, and methodology is very critical. And the documentation may include appraisals, tax assessment records at the day of acquisition, allocation calculations, engineering costs, an internal memorandum and conclusions that organizations determined in order to record allocation of land and building at that time. And ideally, fixed asset schedule should separately track building, land, and land improvements rather than combine everything as one purchase. So before we finish today's episode, let me summarize some ideas, important ideas that we discussed today. Land is generally considered non-depreciable fixed assets and viewed as having an indefinite useful life. That's why we do not record depreciation. Building and many land improvements generally depreciable and they wear out over time. When an organization purchases real estate that contains both land, buildings, and some improvements, it needs to be allocated. But allocations should not be arbitrary. It needs to be supported by reliable, reasonable methodology, documented and retained over the useful life of the assets, which is typically can be up to 40 years and longer. That documents needs to be preserved in a permanent file of non-profit and be available for the auditors and for the accounting records overall. The proper allocation is important because it directly affects depreciation expense, fixed assets records, and financial statement accuracy. And because fixed assets such as building and land typically expensive and material assets, they can have affect financial statements materially and make financial statements materially misstated. In our next episode, which will be our final episode on fixed assets, we're going to discuss the several important topics of the fixed assets, such as donated fixed assets, fair value determination of the fixed assets, collections, and several other practical points related to nonprofits. Thank you so much. Hopefully you enjoyed this episode, and thank you so much for being here with me. Looking forward to our last episode. Thank you.